Now let's get more on the markets and whether investors should continue to expect the slow and steady gains that we've been seeing as of late. Bill Strazzullo is chief market strategist with Bell Curve Trading. He says the market is clearly priced for a soft landing. Peter Schiff, president of Euro Pacific Capital, says we're headed for higher interest rates and weaker earnings, a toxic combination for the markets. Welcome to you both.
Thank you.
Clearly with two totally separate opinions about this. Bill, I'll start with you. I keep hearing the word orderly. That seems everything seems to be coming together in an orderly fashion with the economy, and now people say the markets seem to be moving higher in a slow and steady way. How do you see it?
Liz, we really see the broader market as being range-bound in the S&P between 1350 on the upside and 1200 on the downside. Much earlier in the year, end of the first quarter, beginning of the second quarter, with the market almost at the same levels and the economy even stronger, we advised our clients to be defensive, take a step back, and book some profits simply because we felt the market was at the upper end of the range, prices were extended, and the risk-reward didn't really make sense. If you fast forward to today, we're basically at the same levels, and it's really the same issues, that the market is, again, priced really for perfection. We have a market that's priced for no Fed tightening, a soft landing in housing, subdued oil prices, all calm and quiet on the geopolitical front. And the bottom line here is that there really isn't a whole lot of margin for error. So we're telling our clients right now that to be careful, to be defensive, and take a step back.
Well, Peter, how do you view the recent market
moves?
I
basically agree. I mean, I think the market is priced for a soft landing. The problem is we're not going to get a soft landing. I don't even think we're going to get a hard landing. I think we're more likely to get what I've described as a crash landing. You know, the market, we've been in a bear market here in the U.S. for at least the last 6 years, and during that period of time, there have been many false rallies, and every rally has failed, and I think the current rally is no exception. But I think what you really have to look at is some of the data that's come out recently. Last week, we got a record trade deficit. This morning, they released a wide increase in the quarterly current account, much wider than forecast. And more importantly, we saw a big decline in net foreign purchases of U.S. debt. And, our entire economy, our consumer-based borrow and spend economy, can only exist as long as foreigners are there to supply us with the capital and the goods that we need. And I think in short order, I think that's going to come to an end.
Bill, go ahead.
Yeah, I think there's a couple of things investors should look at right now and a couple of things they should do. First of all, if I'm right here and we really are at the upper end of the range, then if the market is still sitting here the middle to the end of October, then I think you have to reassess. I mean, we really look for the market to begin to drop here in the next 4 to 5 weeks. The second thing you want to look at is volatility. We see the VIX right now down around 12. The thing that concerns us right now is not only are prices extended, but also investors are complacent, which you see in these low volatility indicators. Generally, that's not a good combination. In terms of what investors should do at this point, I don't think you're going to hurt yourself at all by taking some profits. The market has had a nice run under some difficult circumstances.
Yeah, I agree.
Secondly, quickly, Peter, how would you advise your clients to behave in this atmosphere?
Well, I agree, and I think some of the CNBC viewers should follow the lead of Warren Buffett. You've been reporting on him several times today.
Sure.
But he's been investing Berkshire Hathaway money in foreign markets, in foreign equities. And the reason he's doing that is to get out of the U.S. dollar and to acquire assets that are not only based in foreign currencies, but throw off dividend streams in foreign currencies. Because I think people have to be not only defensive against a market decline, but against a dollar decline and a rising cost of living. And despite what the government says and what Wall Street likes people to believe, there's a lot of inflation, and it's only going to get worse. And people have to be very cognizant of their purchasing power.
Peter Schiff and Bill Strazzullo, thank you very much for joining us.
Thanks for having me.
Michelle?